Hi everybody, and welcome back to video number 8 in chapter 22. And when we left off, we were looking at a net loss with a negative cash flow. And here, Juarez Industries has a net loss of $80,000. The only adjustment for the operating activities section is depreciation expense of $25,000. That makes it pretty easy. So the question is, how would you present the operating activities section of the statement of cash flows for Juarez? And as we look at the solution, after making the adjustment for the non-cash expense item, Juarez reports a negative cash flow from operations as follows. So here's the $80,000 loss. We make an adjustment by adding back the depreciation of plant assets. So we have negative net cash used in operating activities here of $55,000. So significant non-cash transactions. Common non-cash transactions that a company should report or disclose. Number one, the acquisition of assets by assuming liabilities, including capital lease obligations, or by issuing equity securities. Number two, exchanges of non-monetary assets. Number three, refinancing of long-term debt. Number four, conversion of debt or preferred stock to common stock. And number five, issuance of equity securities to retire debt. So let's look at a schedule presentation of non-cash investing and financing activities. Here, we had a net increase in cash. We had cash at the beginning of the year. So the cash at the end of the year was $8,925,000. Non-cash investing and financing activities. We purchased some land and building by issuing 250,000 shares of common stock for $1,750,000. We exchanged Steadfast New York land for Bedford, Pennsylvania land for $2 million. And we converted 7% bonds to 50,000 shares of common stock for $500,000. So what we're going to do here, or the companies may just present these non-cash transactions in a separate note, as shown here. So note Golf is significant non-cash transactions. During the year, the company engaged in the following significant non-cash investing and financing transactions. And it tells you what it did here. Same numbers as we did in the prior slide. Okay. So now we're going to take a look at addressing special problems in preparing the statement of cash flows. And the following items must be considered in preparing a statement of cash flows for Clementi Company for the year ended December 31, 2025. Alpha, during the year, 9,000 shares of common stock with a par value of $10 per share were issued for $21 per share. Bravo, uncollectible accounts receivable in the amount of $20,000 were written off against the allowance for doubtful accounts. And Charlie, the company reported a net loss for the year of $40,000. Depreciation amounted to $15,000, and a gain of $7,000 was realized on the sale of available for sale debt securities for $35,000. cash. So they want you to state where each item is to be shown on the statement of cash flows, if at all, and given that Clementi uses the indirect method for operating activities section. Okay, so for alpha, selling shares of common stock for cash is a financing activity, pretty obviously. Therefore, $189,000, that's your 9,000 shares times $21 per share here, is reported as a cash inflow from financing activities. Pretty straightforward there. Bravo. A write-off of accounts receivable does not affect cash. Therefore, it is not shown on the statement of cash flows. The note is the change in net accounts receivable is an adjustment to net income under the indirect method. Okay. And then Charlie, these items are reported as follows. Cash flows from operating activities include the net loss of $40,000 to start us off. Then we're going to adjust that by adding back the depreciation expense, subtracting out the gain on the sale of the AFS debt securities, and that gives us the net cash used by operating activities of a negative $32,000. The cash flows from investing activities include $35,000 here for the sale of those AFS debt securities. Okay. Now we're going to explain the use of a worksheet in preparing the statement of cash flows. If you're like me, you love Excel for these kinds of things. And so here, the XYZ company, this is sort of a template. It shows the balance sheet amounts. We have debit balances here, the end of year balances, reconciling items, debits and credits, and then the end of current year balances. And then the statement of cash flow effects. We have our operating activities, net income and adjustment, investing activities, receipts and payments, financing activities, receipts and payments, and finally, the increase or decrease in cash and the totals. Pretty straightforward, I think. Okay, guidelines for using a worksheet. Number one, in the balance sheet accounts section, you want to list accounts with debit balances separately from those with credit balances. So that means, for example, that accumulated depreciation is listed under credit balances and not as a contra account under the debit balances. And we'll enter beginning and ending balances of each account in the appropriate columns. Then, under the transactions that cause the change in the account balance during the year as reconciling items in the two middle columns. So after all those reconciling items have been entered, each line pertaining to a balance sheet account should foot across. That is, the beginning balance plus or minus the reconciling items must equal the ending balance. When this agreement exists for all balance sheet accounts, all changes in the account balance have been reconciled. Number two here, the bottom portion of the worksheet consists of operating, investing, and financing activities section. So accordingly, it provides the information necessary to prepare the formal statement of cash flows. Here you will enter inflows of cash as debits in the reconciling columns and outflows of cash as credits in the reconciling columns. Thus, in this section, a company would enter the sale of equipment for cash at book value as a debit under inflows of cash from investing activities. Similarly, it would enter the purchase of land for cash as a credit under outflows of cash from investing activities. Number three, we do not want to enter in the any journal or post to any account the reconciling items shown in the worksheet. These items do not represent either adjustments or corrections of the balance sheet accounts. They are used only to facilitate the preparation of the statement of cash flows. Okay, so here they go through the 3 steps. 1, we'll enter the balance sheet accounts and their beginning and ending balances in the balance sheet accounts section. Number 2, we'll enter the data that explain the changes in the balance sheet accounts other than cash and their effects on the statement of cash flows in the reconciling columns of the worksheet. And finally, number 3, we'll enter the increase or decrease in cash on the cash line at the bottom of the worksheet. This entry should enable the totals of the reconciling columns to be in agreement. Okay, here is the Satellite Corporation with an illustration of comparative balance sheets in a worksheet. Pretty straightforward there, I think. Now we will prepare the combined statement of income and retained earnings. So here's our net sales, other revenues, expenses, etc., income before tax, and then our net income here. And as we start with our beginning retained earnings, we'll subtract dividends, we'll subtract stock dividends, and that gets us to retained earnings balance of $592,000. And of course, we show the per share amount of net income. Okay, I think that's pretty clear. All right, here is additional information on the Satellite Corporation. And alpha here, other revenue of $3,500 represents Satellite's equity share in the net income of Porter Company, an equity investee. Satellite owns 22% of Porter Company. Under Bravo here, an analysis of the equipment account and the related accumulated depreciation indicates the following. Here we have our equipment, accumulated depreciation, and any gain or loss. And we start with our balance at the beginning of the year. We go through purchases and sales and depreciation and major repairs charged to accumulated depreciation, and our balance at the end of 2025. Under Charlie, the land in the amount of $60,000 was purchased through the issuance of a long-term note. In addition, certain parcels of land costing $10,500 were condemned. The state government paid Satellite $18,500, and that resulted in an $8,000 gain. Under Delta here, the change in accumulated depreciation dash buildings, trademarks, and premium on bonds payable accounts resulted from depreciation and amortization entries. And then under Echo, an analysis of paid-in capital accounts in stockholders' equity disclosed the following. And here we have our common stock column and our paid-in capital in excess of par for common. And our balance at the beginning of the year, we issued some 2% stock dividend, we sold some stock for cash, and we had a balance at the end of 2025 of $60,000 and $187,000. And finally, Foxtrot, the interest paid, the net amount capitalized is $9,000, and the income taxes paid is $47,000. That looks like a good place for us to stop this video. And when we return income and retained earnings statement for Satellite Corporation, some additional information.